And this is all recorded. That's great. You're going to use this. You're going to use this. Oh, God. I got to stop. I got to look at the recording. I got to look at when. God, Dave.
Good morning, good afternoon, good evening. You have joined us for the next episode of Playbook of the Wealthy. We are talking about what happens when your income grows too fast. Heather's in a wonderful mood where she may get a little sassy later on, so you definitely want to listen to this episode. If this is your first time here, my name is Dave Grants. My co-host is Heather Townsend. Our podcast is split into 4 sections where you get to know us personally, professionally. We dive into content, and then we answer questions. You have to earn Heather's sass. The way you earn that is you like, comment, subscribe, share. I don't know what else you can do. Screenshot, throw it into the group chat, put it in a Discord. Give me a compliment. I don't know what you need to do, but you need to do something. You can't listen to this for free. But because we're a financial services podcast, we do have disclaimers. Jordan, go.
All opinions expressed by Dave Grant and Heather Townsend are solely their own opinions and do not reflect the views of their respective wealth management firms. This podcast is for informational purposes only and should not be relied upon for investment decisions. Nothing in this material constitutes a solicitation for the sale or purchase of any securities. Clients of Retirement Matters and Townsend Financial may maintain positions in the securities discussed in this podcast.
This is the first section of our podcast. It's called What's New? Heather, what is new in your world?
Okay, I actually have a really big win this week. All right. Did I ever tell you one of Lisa's first tasks of working with me? Like, she had a huge project to take on. It was organizing my email box. I don't think I've talked about this, have I?
Oh, okay. No, you have not.
Okay. Are you ready? Do you want to know how many emails were in my email box?
Are we going to play higher or lower?
Yes, let's play it. Let's go.
Okay, 500.
Way higher. It's not unread. I just mean how many has to be organized.
Okay.
We're getting down to email box 0.
And it's higher than 500.
Way high. Oh.
5,000.
Way higher.
I'm not going higher because I'm getting disgusted. 10,000.
28,000.
That is terrible.
No, I know. I understand. What's scary, though, is most people who have worked for me on a contractor basis say I'm one of the most organized advisors they've ever worked for, which scares me to bejesus. But anyways, point being is, I have 2 emails in my inbox right now. We are basically at 0. We are basically at 0. We have won. We have made it. She did it. She organized my entire email box down to 0.
So is this through folders that she's been putting stuff in?
Yeah. I mean, I don't know if you use Outlook or Gmail, but they don't have folders. They have those little, what are they called? Sub-labels. So they're all in sub-labels.
I use Apple Mail, so I make folders. You know what she could have done is she could have hit select all and delete.
She could have, but I didn't want that. What I love now is each client has its own folder. And so now when I'm like, oh, wait, what did that client say about that? I can go into the folder. It is really helpful, actually.
Yeah.
I love it.
I agree. Someone who has folders and lives by inbox 0. It's wonderful.
Okay. Well, I'm just hopped on that train and it is amazing. Yes, I'm winning. Down to 0. Woo! Okay. What's new with you, Dave?
I cheated on you. That's what's new with me.
Oh my God.
I did it. I've talked about it. I've alluded to it, but I actually did it.
What did you do?
I launched another podcast.
Well, hold on. Cheating with me technically would be you did it with someone else. Did you do it with someone else?
No.
So it's by yourself?
Yes.
So you just decided you like to talk to yourself more than talk to me?
Oh, don't open that door. Oh, that could be a slew of comments there.
I told you I'm sassy today. I'm sassy. And you started with your cheating on me. So, it got me on the defensive and I'm going to get you.
All right. So some backstory. I did a podcast probably 4 years ago called the 5-Minute Financial Plan. That was fine, but I actually missed that because the reason it was 5 minutes because each episode is supposed to be 5 minutes long. And it was like one action point of your financial plan. I then have relaunched that. It's called the 5-Minute Retirement Plan because, someone has trademarked 5-Minute Financial Plan, which was terrible. So it's the 5-Minute Retirement Plan. It's on Apple, it's on Spotify. Each episode is roughly 5 minutes long, and it's either one learning point about retirement or one to do in order to prepare for retirement. Comes out every Monday. Go find it, subscribe, enjoy.
And that was Dave's little plug.
Oh, it's going to be a plug every week.
Oh, geez. Okay.
Let's dive in. All right, we're talking about climbing incomes here. So we're dealing with how to deal with an increasing income. It's actually a little harder than you might imagine.
Wait, can I, before you go into your tangent of this, you said grow too fast. Can income grow too fast?
Yes, I think it can.
Okay, you now have to explain.
I think some people, when circumstances happen and their income grows rapidly, aren't prepared with how to deal with it.
Oh,
and until you've learned skills on how to deal with higher incomes, it is too big for you. So when we're talking about bigger incomes, the average household income in the United States is $80,000. We're not talking about that today.
No, this is Playbook of the Wealthy.
Don't shame people who earn a household income of $80,000, Townsend.
I'm not
Relax.
shaming anyone. Jeez.
Listener, you see what I have to deal with? Jeez, come on. All right, we're dealing with people, earning 150,000 plus by themselves, or when they're getting into a household of 300,000 plus. Once you get to that income, two things happen. One, you can either hit a ceiling or you blow past that ceiling and it accelerates beyond that quite quickly. So I'm sure people are like, well, how on earth do people get to that point? So we're talking about job hopping or frequently changing jobs or relocating. And then if I go to an X company, are they going to pay me more? What happens if I take that offer and I shop it with another company? You can start to use all these strategies to start to really accelerate that income. But then it also happens when people are very well educated. We're talking about people, MBAs, PhDs, doctors, lawyers. Once you get up to that echelon of education, you can start to really figure out, okay, I can charge a lot for my education, expertise, and time at this point.
It's so funny when you talk because I just realize how different our clientele is sometimes from each other. It happens to my clients because they're either business owners or some of them are realtors. So they have a ton of closings in a short amount of time, or the real estate market is just thriving. It's just or they get all these new customers all of a sudden or new contracts. And then you have the execs. It's very funny. My income, growing with my clients is very different than your income growing with your clients. It's just interesting.
It is. That was a bullet point I was going to go over, which was business owners. Thank you for covering that for me.
Well, you were just talking about execs. You led me into that. I was like, excuse me, that's just not it.
I wasn't done.
Okay, continue.
Wow.
I am so
This
sorry.
is really early in the episode to be getting like this. Holy cow. And
you started with you cheated on me. I mean, you are just asking for it the rest of the episode, Dave.
I'm not going to apologize. It was true. And we're also talking about stock grants. So if you're working for a tech or pharma company, chances are if you get a stock grant and that company accelerates in growth, hold on, because your stock grants are going to go a lot higher than what they are now. And then the flip side of that is if you've got a private company that IPOs, you could be $1 million richer just by that one event. So what happens? I'll tell you what happens. People love to spend it.
Oh, of course. It's way easier to spend than save. I don't think anyone's going to argue about that. So much easier to spend than save. People can think, oh my gosh, I have all this money. Lottery winners. But let's just use that one. How many lottery winners have generational wealth? I'd have to look that up, but I'm guessing it's ridiculously
minimal.
Small.
Yeah.
Minimal. Yes.
So we're talking about lifestyle creep. Yeah. Let's talk about, okay, if your income went from, as a household income, let's say it went from 300,000 to 500,000 in the space of a year. What are you going to do? Well, you're going to upgrade stuff. So you're going to upgrade your car, you're going to upgrade your home, you're going to upgrade your vacation, your housing, your experiences, everything. Because why wouldn't you? Like, that's fun stuff to do. But what you've just done is you now have handcuffed yourself to that new level of lifestyle. That bigger home is not going to get cheaper. That's going to get more expensive. We're ignoring mortgage rates at this point. Cars. There's a thing in personal finance called anchoring. So when you upgrade something, so you upgrade a car, you have now anchored yourself to this is the minimal level of car that you are going to accept for yourself going forward. So if you
I did that at the age of like 16, just so you know.
Thanks for giving us an example of what not to do in life.
It worked. Oh, geez.
For the regular person, if they go and buy a BMW and they stretch to do that, they're not going to go back down and do a Honda Civic. Gladly.
No, well, I know. No, they will not. I couldn't do it. It actually is what forced me to work so hard. I knew I had to drive a BMW for the rest of my life.
So I would say that worked for you.
Mm-hmm.
That then became that driving motor of I now have to become successful because I have that minimal level of car that I want for myself. I don't know if that works for everybody else.
It does, but it's a great example of like what I don't need is a big mansion. That doesn't excite me. Like, I think big houses are amazing. I love to look at them, but I don't need one. Right now in my current life, I don't want one.
Yeah. So personally, we've gone through this in our household. And it's been a case of, okay, when we bought our house 10 years ago, and when we were looking at a new house in the last couple months, just because of mortgage rates and how house prices have gone up, we would have to 2.5x our payments each month to afford to go up to the next level of house. That was a really difficult thing to go through because we like what's on the other side. That's a really nice house. We could move to a neighborhood where all our friends are, and it makes it easier to hang out. Kids are closer to school, but now we're locked into that. Would we rather be locked into that, or would we rather be locked into our house and its pros and cons and have cash in our pocket and more freedom? That's essentially what we chose. But it's hard. It's hard to not spend that money when it comes to you.
It is very hard. I actually went through that same thing last fall. I think I shared it with it on one of the podcasts, but I did go get like our dream house and everything. And then it was my husband. He was like, why are we doing this? Like, why? I don't want that. I don't want that stress. And he was right. I was like, I don't either. Why? Like, no. Okay. Moving on though.
Yeah.
Okay. People have this income. Can I just do my SaaS right now? It's not that hard. Do you know where people go wrong? They don't have a fluffing plan. Okay. So I like to get with my clients. That's why we do registered life planning. We do their life design. We figure out what they want in their life. We figure out what's important to them. We figure out what they need to do to financial freedom. To get to financial freedom, income comes in. We go through that list in that order. And if something changes, we will talk about it. But the problem is people get extra income and they don't know what to do with it. And they don't even really know what they want out of life. And so they just spend it.
Mm-hmm.
But if you know, go ahead.
Well, there is simple steps to take. Like, yes, you can have that life plan, but for people who don't have a life plan, there's really only 4 things they should be doing in order. You want to hear them?
I do. I'm very interested that you can already narrow it down to 4. Please enlighten me.
For everybody, regardless of what this income increase is going to be. Here we go.
Am I going to agree with this?
Probably not. So the first thing you're going to do is you're going to pay off all the debt except your house. It's gone.
Oh my gosh, I am so going to disagree with this. I am already. Are you fluffing kidding me? Are you serious? You're going to have someone pay off all their debt in their house?
Are you done?
No.
Let me get through the steps and then you can scream into your microphone.
Okay.
So, you're paying off everything except your house.
Oh, except your house.
See, this is what happens when you listen. So you're paying off credit cards, consumer loans, cars, student, and everything that doesn't exist except for your house. Get that free and clear of that's the only thing you have owing on is your mortgage. Then you're going to build up that emergency fund. because you've got a higher income, chances are you have got some lifestyle creep anyway. So you have to have that 3 to 6 months of expenses lined up, and it may be bigger than it may have been previously. If it's one income in your household, it's got to be 6 months. If it's two income in your household, go between 3 and 5. Then you have to be doing that long-term investing. It is not in terms of dollar amount. We're talking about percentages of your income that you're saving. So in my eyes, it's you're saving 15% to retirement, whether that's between pensions, 401ks, IRAs, or cash. 15% there, and then you've got other savings outside of that, whether it be college or other goals that you have. And then once you're done with that, then you can start to look at, okay, if we've got excess cash, what can we do to enjoy that? So those are the 4 things. The floor is yours, Townsend.
I'm a little different. It's a great list. David is a wonderful list. I'm going to do the sandwich.
Go ahead.
Here's the thing that I've noticed. And again, some of my clientele is different, right? They don't have steady income if they're a business owner. Okay. It's not like paycheck comes in. So it's very different. A lot of times they can just get this huge amount of money in a very short period of time. But the thing is that people are going to pay that car payment. People are going to pay their mortgage. Getting them to invest can sometimes be harder because it's really gone. And so from like a mindset shift, if the debt is something they can afford, we have emergency reserves. I might have them invest some to get to their targets to financial freedom and continue paying down their car, the normal payment, whatever, depending on interest rate and all of that. So I do switch that, but you and I have a different, not right or wrong, just different risk tolerance with debt.
Yeah.
And mine is 20%. For saving is my target for retirement. But I also think some of my clients, again, they're business owners. There are sometimes years where we don't put anything away. So mine is 20% target because they'll have good years, they'll have bad years. It's just different. So I like to target 20%. And I think that's it.
Nice. It does depend on how this is coming in. Like if you're a business owner, it can be feast or famine. Like you may need to hold a lot of that in cash because you never know when that income could come back in again.
Well, and for my business owner clients, I definitely think we keep more than 3 months because of that. You know, I think if you're, I don't know, I'm going to make up some career, but like an engineer where you could really quickly get another job, 3 months probably is sufficient. But for a business owner, that their income can really be really volatile, like a realtor or something like that. I definitely have them keep more than 3 months. And I actually have them keep buffers in their business too. So it's not just personal, it's business too.
Yeah. Well, let's talk about lifestyle creep because that's something that people sometimes don't think about too much. So I was looking up studies. There's a great blog called ofdollarsandData.com. They did a study on lifestyle creep, and they actually found that there's a, how to describe it? If you're going through very tiny incremental increases in your income, it's easy for lifestyle creep to come in there because it's just a small amount of income. Why would I not spend it and have some fun with it? They found that once you do that, once you get to a certain point, then lifestyle creep stops. Then people start being very deliberate with what they do with their money. But then as your income starts to increase even more, then lifestyle creep comes back in because you can level up to the next stage of life. So it's almost like you describe it, like the smile effect of at the start. Yeah, lifestyle creep's a real problem. Then it's not, then it's a problem again.
It's interesting. So in our household, one has a steady income. It's very similar to yours. Your wife has a steady paycheck, right? She's not a business owner. And then I'm the business owner, right? And so like my husband's raises, they're good, but they're not like life-changing money, right? Even a promotion.
Sure.
And so I can totally see it's like, oh, it just gets absorbed into that paycheck that you receive if you're not smart with that small percentage, even though it can amount to a lot over 5 years, like even a 5% raise every 5 years, that means your income grew what? Over 25% because it's compounded, right? 5%.
Yeah.
So maybe it's like 30% or something, but you might not notice it if you don't do anything with that. So I think it's really hard to, you might just dine out more. What I do with those clients is when they have that raise, and I did this with our household, is I'm like, oh, you don't need all that 5%. Let's up your 401k by 2. Like, I don't ask for the full 5, but I get 2. I say they get 2 to their 401k, but I'm like, up 2. I mean, I'm the financial planner here. So my husband already maxing out 401k, HSA, all of that. So what we did is every time he gets a raise, because I don't want any more lifestyle creep in our household, is I put it directly to our brokerage. I go, okay, you got that raise. All right, I need what was your old paycheck? What was your new paycheck? And I literally take the delta and increase our distribution to our brokerage.
Nice. So yours is automatic. Rules-based.
I think it's, for my business, that's hard. I think lifestyle creep with businesses is harder to track, I've noticed. His is so much easier. When you have steady income, it's very easy to see that delta. Businesses, it's like my expenses are variable. Like in December, I have to pay my cybersecurity software. That, by the way, is $8,000, right? Like that's a huge expense all in 1 month. Or, okay, in March, I have to pay, all the ADV renewal fees and everything, right? Like I think in a business, you look at your profit, but it's very variable. I don't know about you, but like my business credit card kind of like bing bongs around depending on what's going on, what's due. If I pay my one subscription for a software all in one for 1 year, right? It just depends. Or I have to travel for a conference, whatever it is. So I think it's harder to really like pinpoint what that income increase is because business expenses, at least in my business, have changed, especially as I've grown too, right? They've increased. Sure. You need more help. Whereas when you have like stable income with a salary, it's easier to see with a paycheck. I find it way easier to track my husband's than it is for my business.
Yes, I agree.
So you have to be like really careful. So I like instead I make rules like, okay, I'm going to max out my solo 401k for myself. Like I have to make, or a certain percent, I think is like very helpful. Like I always put 30% aside for taxes, right? Like I think with business owners, you have to do it on a percent basis. Like this was my profit for this month. So it's like the profit first method. So this percent. So like 10% is always going to go to savings or whatever it is. I think it's very different than like business versus, I have to treat both in our household very differently.
Okay. The tough part about this, and it's the gotcha, is yes, your income is growing and it feels great, but guess what? Uncle Sam wants his cut too. Like you are not getting away from a larger tax bill just by making a bigger income. This goes hand in hand. So you're going to have to figure out, are you comfortable paying a larger tax bill? And if you're not, let's figure out some strategies of how to get that down. The way to get that down is to put money in tax deferred savings. If you're a business owner, you probably have a little bit more levers to pull. But if you're a W-2 earner, you really don't have too many.
W-2 is hard unless you go and buy like rental real estate. Like it's hard. Or do some crazy like oil investments. So
I think in terms of W-2, we're looking at maxing out that 401k. Chances are you're there already if you're getting into that higher incomes. You may want to look at deferred comp in your company. I've had some people take this to the extreme. And when you take it to the extreme, you end up poor and you can't afford the life that you're in right now. So be very careful with this because once you change it, you can't change it for another 12 months. You did mention real estate and oil and gas. I'm going to scratch those in my clients' lives immediately. Like if you want to become a landlord, buy real estate. Perfect. Go buy more. Become just buy 7, buy 10. But why?
I don't mind it as much. I don't mind it from a diversification, but I have a lot of clients in the real estate industry. Like I really mind it if that's all they have. It has to be a 50-50 approach. And that some of them do like being landlords. Like I don't have a problem with that. It's managed well. We keep buffers and each rental property has its own bank account. We keep buffers. I'm fine from it from a diversification standpoint. I don't like it though when you reach retirement.
But realtors love it. They like building up a portfolio because that's their world. If you're
And
in
I
the
think they're good
pharmaceutical
at it,
space,
though.
they are.
They
If
are
you're
good.
a scientist or you're an engineer or you're a software engineer, don't buy real estate because you think it's a way to get wealthy or diversify. It's not, because you don't have the knowledge to do that.
I think like realtors, that's a part of it that I really understand is they're in it every day. If I was doing that all day selling real estate, I would then easily be able to see when there's an opportunity. Because I'm like,
Right.
oh my gosh, this is at what price when everything else is, but this is it. You can see it. You're in it all day.
Yeah. I mean, I think if people want to own real estate, buy a REIT, so a real estate investment trust. That will get you exposure to real estate, but you don't need to be buying houses with this increased income. Like keep life simple here.
Yeah, I like that. I'll be quiet, but I like DSTs.
Fine. We're not going down the rabbit hole. All right. And the last thing is you have got more money than the majority of the world. So bless some people with it, whether it's family, friends, charities, whatever it's going to be. Bless some people with your increased income and your now growing wealth. If it's friends, pull up those people who are wanting to be in the same place as you, however you can. If it's charities, do it in a smart way so you get some benefit from it too, from a tax perspective. But you are too blessed to be keeping all this income to yourself.
It feels good to do because I think that the studies have proven that, and it is true, when you give your money away, that's when you really start feeling wealthier. Like the happiness that it feels, like it releases endorphins, I think, actually. Like it's an amazing feeling and you really feel wealthy when you gift your money.
All right, let's move into our question segment. It's called What Would You Do?
I just got promoted to a higher executive role in my company, and it comes with a large salary increase and more benefits. RSUs, deferred comp plan, employee stock purchase plan, aka ESPP. How do I plan for this income and use the available benefits?
Love this. This is 50% of my client base. You're going to be spoiled for choice here because you could put all of your income into these things. Deferred compensation plan, you put all your bonus in. Employee stock purchase plan, you could buy all the stock of the company at a discount. But that's where it comes back to, what is your life design here? Like, where are you at right now? Is that where you want to be? And if not, where are you going? That should all be mapped out before any of these come into play. So for RSUs, you're going to get stock every year. You should be selling that stock and putting that into work with your long plan. Some of that should go into investing, some of that should go into spending. Same with a deferred comp plan. How much of your income do you not need right now? Let's design that into a retirement plan and defer some of that income for a later date. Same for employee stock purchase. How much is the discount that you get for buying the stock? I don't necessarily want you to hold the stock, but it's hard to turn down a discount. So how much do you want to buy and then sell when that time comes? So planning for all of those things just comes into a larger plan of what your life's going to be.
We haven't talked about that. Are you a fan of ESPP? Do you do that?
No. I don't have many people where it's available to them.
Oh, I've heard like advisors say, I don't like it because it adds complexity. And, at the end of the day, the benefit isn't that big. I'm like, oh, if you get your client to put 1% of their salary away and then they sell it and they think they got a discount, which they really do. It's a nice discount. Normally it's like 15%. And then you get in money that was unexpected because it's a lump sum that they then get when the stock is bought for them. And you make them put that in their towards their financial freedom accounts. It works well. It's that like money psychology game I play.
Mm-hmm.
Yeah.
Yeah. I don't have many people that do it, but it's hard to turn down a discount. It's like turning down a company match.
Yeah.
Like, you don't have to keep this stock when you buy it. Just buy it for a discount and then sell it.
That's what I have my clients do. Yep.
Second question. I am 34. My income has increased by 25 to 40% each year for the last 4 years. I've gone from earning $100,000 annually to just over $300,000 annually. Lifestyle creep is a real thing. How do I balance this with preparing for my future?
Well, hopefully this podcast helped you. What I'm worried about when I read this is I hope this human, whoever you are, didn't already add on things in your life, like bought the bigger house or got this really expensive car, something that you can't change. So now you don't have any leftover discretionary income to save towards wealth or design your life. That's what I'm worried about when I read this, because they say lifestyle creep is a real thing. So if they went in 4x their mortgage, there might not be much they can do at this very time. But I mean, hopefully after listening to the episode, what I will say is you've now learned the lesson. If you're good with where you are, design your ideal life, see how close you are to it, see what you want to change. And then going forward, as your income grows, every time you get that increase, bump up that 401k or set up an automatic reoccurring transfer to your brokerage. Do your backdoor Roth if you can. Just have a plan with that increase in wealth, and at least 50% of it, when your income increases, put it towards saving, towards wealth growth. That's what I would do.
This is a fun one. If you haven't listened to our FIRE episode, you could be fired by 50 if you just keep your $100,000 lifestyle and save the rest. So figure out what you want life to be.
Question 3. My wife and I, both 50 years old, sold our business this year. We went from earning $600K combined per year to 0. Ooh, the sale netted us 1.5 after taxes were paid, which we added to our portfolio. Good job. Which totals $3.5 million across all accounts. We're stuck as to what to do now for income.
Interesting that this question is just talking about income. It's not talking about anything else. So you sold a business and now you're earning nothing and you're 50. Looks like you're either starting another business, because that's typically what business owners do. It's hard to go work for someone else. Or you are going to work for someone else. It's not going to really make you 600.
Well, or are they retiring? Like, could they retire? $3.5 million? I mean, depending on what they need, they could retire. It's potential.
Could do. They're young at 50. I mean, that depends. Is $3.5 million your FIRE number? Like, could you retire early at this point? $3.5 million, what are you at? 150-ish? If you can live on $150,000 a year, you might need to live on less just because you're so young. But if you want to do that, it'll be interesting. If you're earning 600, were you living at $150,000 a year? I'm going to guess no.
You're right. That's a good point.
So you might need to go back to work for a little bit. And also, you don't want to not go from 600 to 0 and just go cold turkey. Like, that's tough. So go build that social circle outside of work. If you want to have one in work, get some health insurance, save that on your expenses. But maybe just straddle the two. Maybe work part-time. Figure out what you want to do in life. Because this is really where you're going from that we own a business and run a business to we have to redesign our whole life.
Your mind and my mind went to the same place. It wasn't numbers. It was like, oh boy, they're probably getting depressed. That's where my mind went right away.
Depressed and divorced.
I was like, oh, mayday, 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 because most business owners sell businesses and get really depressed. They have a really big problem with it. It's not good. You've got to have that plan of like, what are you going to do next?
That's actually the one fear I have with running a business.
Yeah.
Is I don't want to let it go because I'm afraid of what is the other side.
Oh, that's a good podcast episode in itself. I'm like, that's interesting. We'll have to talk about that. Maybe I'll guide you live through it.
Do my life plan online?
Yeah. Why not?
All right. Let's move into our final section of the podcast. It's called Highlights. This is where we tell you our personal final win for the week without going on for too long. I'm going to go first. My brother-in-law and his wife are both doctors.
Okay.
So it happens where all the medical questions go to them versus people asking their own doctor, which is weird in itself. But my wife and I have been looking for TV shows to watch together. And so we found one called Pulse on Netflix, which is all about an ER. And then there was another one on HBO Max called The Pit, which is all about an ER as well. So we watched one and then we texted them and we're like, is this real? Is this like how it is? And they're like, don't watch Pulse, watch The Pit. The first episode of The Pit, someone gets their leg degloved.
I don't even know what that means. What does degloved mean?
All the skin gets ripped off their leg, but their leg is still there. And
Why
I'm like,
are you? Oh, do you know that blood makes me squeamish?
oh, so we texted them and we're like, is this for real what it's like? Because the whole first season is 1 day in the ER and it's like traumatic. And they're like, yep, that's pretty much real. That's how the relationships are. That's how the patients are. Enjoy. And we're like, I preferred the other one where there was no blood and it was not as graphic.
So I should not watch The Pit. I could not.
No, don't watch The Pit.
Okay.
It's graphic every episode.
No, I couldn't. Yeah. I'm the one that like has to look away when my blood gets drawn, everything. I like sweat. Yeah.
But my wife can watch that, but she can't watch a show with me where someone is lying to someone else. She can't handle that. I'm like, honey, that person just like almost lost their leg. And yes, we couldn't watch for like 3 seconds, but yeah. So personal win. We found some shows to watch that weren't real estate, but they kind of grossed us out.
My personal win of the week is I wired the money to my contractor. We are going to start the remodel. Oh boy. So last episode I say where I'm in peace and harmony and going for the remodel.
Oh, how long are you going to be without a kitchen?
So the contractor he said, it's probably going to take me 4 months, but he wants to be conservative to not upset me. So he said, I'll probably get it done in 2.5. Now we leave a lot of the summer. So I'm already planning to get out of the summer for the heat, but we normally leave for a month to 7 weeks. So I don't know what my husband and I are putting together the summer travel right now to try to figure out how we can time this. And luckily my grandma said we can use her house, but that's a 2-bedroom patio home with a Bernese Mountain Dog, twins, and me and my husband. So I don't know how realistic that is. So yeah, it's going to be a very interesting summer.
Yeah. 4 months though, without a kitchen. That's tough.
I don't know if it's like really 4 months. I mean, we're getting all new flooring, kitchen, our fireplace is getting in our like family room. And yeah, it's going to be, yeah.
You're going all in, doing it all.
Mm-hmm.
That's the way to do it though, right?
Yes. I wish I had done it in the first place, but to get my husband to agree to this, I mean, I've had the design since December.
Yep.
Mm-hmm. Mm-hmm.
Me and you are similar. I was like, let's just talk to a realtor. Let's see what they say about our house.
Mm-hmm.
Sold in 3 days after that. I'm like, sorry, honey. Didn't mean for that to happen. But yeah.
It's actually bad. The 2 gas pedals do the podcast episode. That's interesting. We're the gas pedals. Like my husband is the brake. Mm-hmm. Which is a little interesting because I'm always the brake for my clients. Sometimes the gas. It depends on what they need. It's very fascinating. I'm going to have to think about this.
Go ahead. Think about it while we're done with the episode. So thank you for listening to this episode of Playbook of the Wealthy. You can find us on whichever platform you listen to podcasts, and the video version is on YouTube, LinkedIn, and Instagram, if Heather posts it. If you want to send an email to the show, you can contact us. Contact us at hello@playbookotw.com.
Is that the right email address?
Shut up. Yes, it is. Bye.
Toodles!